Howdy folks, this is Jeff Camarda with a piece called How to Protect Yourself Now in Case Taxes Go Way Up. The 2020 election is shaping up to be one of the most politically polarized contests in a long time. Views on taxes, entitlements, immigration, and even the nature of capitalism between the party's leading candidates could not be more different. Depending on who wins, America's future may leap in widely different directions. While it's way too early to predict who will be in power, it's not hard to tell who has the most to lose from a power shift to the left. Regardless of readers' and viewers' political persuasions, higher taxes cost richer people wealth. Since most viewers of this video and readers of the accompanying article may be more affluent than most, here is a punch list of wealth weak points they may want to start to form plans B for. Since Congress, not presidential talking points or edicts, actually defines new tax laws, the following ideas are general danger points and not answers to any particular candidate's proposals. Even if the Democrats win the presidency and the Senate and keep the House, too much will change between now and then, between now and when they haul out the tax chopping block to make specific plans. But make no mistake, that block will be intended for those with high incomes and net worths. Remember, higher taxes, if they come, will develop over the next few years, so you have some dancing room to work up a plan with your tax preparer and tax advisor. So, number one, income taxes. Look for rates to rise and deductions for businesses and the well-off to get squeezed. If you believe income taxes will go up, here are some strategies to consider. A, Roth conversions, converting more converting more of the value from a Roth IRA into converting more from a traditional IRA to a Roth IRA now, paying a tax on it, locks in current tax rates, and converted amounts will then grow tax-free. Number B, accelerate recognized income. If you have flexibility on recognizing more income sooner, you'll want to consider this. Business owners and consultants may be in the best position to do this, but even employees may have some flexibility on when they get bonuses, pull the trigger on stock options and deferred comp, and so on. C, consider accelerating recognized income, consider recognizing capital gains now. If you have appreciated stocks, real estate, or other assets like businesses that you're thinking about selling, recognizing gains soon may lock in lower tax rates. And with the current chatter by some politicians about eliminating the step-up at death, you may not be able to beat the capital gains tax at death after all, as you can under current law. So it may make sense to pay the tax now at a lower rate rather than wait for the gains to accumulate at potential higher rates in the future. D, I think it is accelerate required minimum distributions. If you have pre-tax money in IRAs and other retirement plans, the RMD rules define how slow you can take it out and how far down the road you can kick the tax can or defer paying taxes. There's really no limit on how fast you can take it out, and even if you're under 59 and a half, there are ways to avoid the 10% tax penalty. E, take annuity distributions. Non-qualified annuities, those not in IRAs or other tax-deferred accounts, have similar tax rules to IRAs. Gains are taxable as ordinary income. You can usually make taxable withdrawals at will. Other potential taxes besides income taxes are planned for. Number one, millionaire taxes, taxing those above a certain net worth with an extra income or other tax. 2, wealth taxes, not to be confused with income tax, an annual assessment on net worth, kind of like paying an estate tax every year. The implied work burden is enough to make you die already just thinking about the math every year. 3, property taxes. These are very, very tough to beat unless you move, and if they go up to finance a social agenda, property values will plunge. 4, higher payroll taxes to save Social Security. Look for high earners to pay lots more tax and get lots less benefit. And 5, estate tax. Wealthy folks viewing this may consider hunkering down and doing a serious estate plan and estate tax check with somebody who knows how, because I think this is probably one of the most insidious taxes that folks think that this wasn't so long ago estate taxes were abolished or repealed, right? Not so now. The exemption is much higher, but it's coming crashing down by half in 2026 if it's not truncated or reduced more dramatically sooner based on political changes. Of course, with the election uncertain and still far away, it'll pay to methodically consider tax exposure and tactics. Still, regardless of who rules Washington in the early 2020s, one thing is certain: deficits, Social Security, and Medicare costs will go to unsustainable levels in a few short years now, and the money will have to come from somewhere. The best bet is higher taxes. Even if we dodge a bullet on higher income taxes in the next administration, expecting estate and other taxes to not go up in our lifetime is pretty much a pipe dream. Those who have ears, please hear. Till next time, thanks for watching. Sorry if that got a little bit technical and I got a little bit tongue-tied. I'll try to do better next time. This is Dr. Jeff Camarda. Bye-bye.